We are covering active versus passive investment management for the Series 65 exam. This is a critical topic that ties directly into your fiduciary duty as an investment advisor representative. The exam will test your understanding of the core differences, costs, tax implications, and performance history of these two strategies. Passive management involves creating a portfolio that aims to track a market index, like the S&P 500. The most common vehicle for this is an index fund or an exchange-traded fund, also known as an ETF. The goal isn't to beat the market, but to be the market, matching its performance as closely as possible. Active management, on the other hand, is what it sounds like. A portfolio manager or team actively makes investment decisions, buying and selling securities with the goal of outperforming a specific benchmark. For the exam, the most important distinction to grasp is cost. Actively managed funds have portfolio managers and research teams to pay, which leads to higher operating expenses. These are reflected in the fund's expense ratio. Passive funds simply need to replicate an index, so their expense ratios are significantly lower. In 2021, the average expense ratio for an active fund was 5 times higher than for a passive fund. This cost difference, compounded over many years, creates a very high hurdle for active managers to overcome just to match the market's return. The exam loves to test this concept through questions about fiduciary responsibility, implying that recommending a high-cost active fund over a similar, low-cost passive fund could be a breach of duty if not properly justified. Another key area tested is tax efficiency. Actively managed funds often have higher portfolio turnover because managers are frequently buying and selling securities. Every time a security is sold for a profit within the fund, it creates a capital gain, which must be distributed to shareholders, creating a taxable event for those holding the fund in a brokerage account. In contrast, passive index funds have very low turnover. They only sell a security if it's removed from the underlying index. This lower turnover results in fewer capital gains distributions, making passive funds more tax efficient. An exam question might present a scenario with an investor in a high tax bracket and ask for the more suitable strategy, where the tax efficiency of a passive fund would be a major advantage. Regarding performance, the evidence is a crucial point for the exam. Numerous studies have shown that the majority of active fund managers fail to outperform their benchmark indexes over long periods, especially after their higher fees are taken into account. One report found that just 21% of active funds survived and beat their average passive peer over the decade ending in mid-2025. A common exam trap is to present a fund with a star manager who has outperformed for the past 2 or 3 years. The trick is to get you to ignore the long-term data and the impact of fees. The correct approach is to recognize that past performance is not indicative of future results, and that costs are a reliable predictor of future returns. For a mental shortcut, remember the passive advantage with the 3 T's: tracking the index, tax efficient, and tiny fees. If a question asks you to compare the 2 strategies for a typical long-term investor, the answer will almost always highlight the benefits of low costs and tax efficiency found in passive management. For free practice questions, AI-powered explanations, and more exam prep tools, visit openexamprep.com. That's openexamprep, all one word, .com.